Hi there, and welcome to 6 huge trading mistakes and how you can avoid them. Mistake number 5, for example, can save you a lot of money if you implement it. I'm champion trader Kevin Davey, and let's get started. So let's jump in and take a look at mistake number 1. Mistake number 1 is the holy grail mistake. A lot of people get into trading thinking, hey, I'm going to come up with a great trading system or find that elusive trading pattern or create the perfect indicator, something that's just going to make me fabulously wealthy with little or no work. In other words, the holy grail. Well, guess what? It doesn't exist. The holy grail is a myth. There is no perfect strategy out there. Professionals know this. That's why they trade a lot of strategies. But a lot of people getting into trading think, hey, there's a holy grail. There's some kind of way that no one else has figured out and it's going to make me rich overnight. It just doesn't exist. So, to avoid mistake number 1, looking for that holy grail, it's pretty simple. Just quit looking for it. Quit thinking that you're going to uncover some deep market secret and that's going to make you rich. What makes you successful in trading is a lot of hard work, and searching for the holy grail is really a fool's errand. Instead of looking for fabulously great strategies to trade, just look for good, solid strategies that have a good risk to return type profile. Mistake number 2 is over-optimizing. A lot of people fall for this, especially with trading software, the way it's set up. It encourages you to optimize systems and, hey, let's try all these different combinations and see which one works the best. This is how most people do it. They'll take a system, they'll take all their rules, make a whole bunch of different iterations with it, they'll take all their data, throw it all together, let the computer run overnight or a weekend, and then they'll trade whatever comes out to be the best result. Well, guess what? That almost never works. Optimizing leads to failure 9 times out of 10. And over-optimizing leads to failure probably 10 times out of 10. So to avoid this mistake, what you can do is first, not have a lot of rules in your strategy. Keep it simple. So instead of 20 or 30 variables to optimize, keep it 5 or less. That'll be pretty good, and that will help stop you from over-optimizing. And if you're running thousands of iterations, if you think you have to buy a faster computer in order to run your trading system and do all the optimizing, chances are your system is too complicated and you're going to overfit and over-optimize. So watch out. And if you need to do genetic optimization or some special tricks to get it to work faster, chances are your strategy is going to be overfit, and that's a bad thing. So mistake number 3, having the wrong metrics. Too many people fixate on the wrong things when they look at a trading system. For example, a lot of people like winning percentage and they think that's the most important thing. Other people say, well, net profit's all that matters. I'll tell you what, neither one by itself is very important. Sure, there's benefits to having a good winning percentage, and of course having a lot of net profit's good, but those are not the key metrics. So traders who really know what they're doing focus on a few key metrics that incorporate 2 things in them: reward and risk. Another way to look at this is what kind of annual return do you get and what kind of drawdown do you get or have to endure to get that annual return. If you use metrics that include both risk and reward in them, you'll be much better off. Mistake number 4 is not knowing what's good and what's not good. And it's kind of related to the metric number, but it's a little bit different. So take a look at these equity curves. Would you think these are good equity curves or not so good equity curves? Well, guess what? It's a trick question. The simple fact is you don't know enough about these equity curves to say if it's good or bad. These could be the results of years of optimizing, so they could be curve fit and they won't work going forward, so they could be junk. Or these could be real results from real trading systems traded in real time, so they might actually be pretty good equity curves. The fact is, you just don't have enough information, and that's what makes looking for trading systems on the internet so tough, because you see an equity curve and you don't really know how it was developed. The fact is, you need a lot more information than just the equity curve. You have to know about how it was developed. And that's why developing systems on your own is a really great idea, because then you know how it was developed. You know what went into it. You know if you over-optimized or cheated and curve fit and did all sorts of bad things. But when you see one out there, you might not know that. So to avoid this mistake, you've got to really dig in to the equity curve that you see and take a look at the strategy. See if you can get the code, find out how it was developed, find out the process, and then also look at real results that are out there. You just have to search for them, but you can find them, and that will help you determine what's a real looking equity curve and what's a fake equity curve. The point is, you just don't know from looking at the equity curve, and that's a mistake a lot of people make. They look at the equity curve and then just make assumptions about a strategy. Mistake number 5, it's a huge mistake. Most people don't have a plan to quit trading a strategy. Sure, they start trading a strategy and they have dreams of the cars they're going to buy, the house they're going to buy, the vacations they're going to go on, all with their trading profits. Very few people think about what's going to happen if my strategy goes bad. When do I quit? And that's critical. You have to know when to quit. Otherwise, the strategy is going to be sucking money out of your trading account until you have nothing left. So to avoid mistake number 5, you have to come up with a way to stop trading a system. So maybe it's based on drawdown, maybe it's based on consecutive losses, but you come up with a way, you write it down, and write it down before you start trading the system, and then you stick to it. So if you have a trading partner or somebody else to help you, have them make you accountable. That'll keep you on the up and up and not cheat when you say you're going to quit a system and just keep going. A lot of people do that, and that's a big mistake. Okay, well, we've gotten through a lot of mistakes. Here's one more for you. When I was in college, I did an internship at NASA, and I actually worked on rocket science type equations for rocket trajectories going to the moon. That was easy because there were set equations you had to use. You just had to implement it. But in trading, there is no set way to do things. Some people trade off of charts. Some people create algos. Some people will use out of sample testing. Some people will not. Some people will do walk forward testing. There's all sorts of different ways to figure out how to trade. And there's many different paths to reach that success. The trick is you have to find one that works for you. So to avoid this mistake, find an approach to developing trading systems or strategies that you like, monitor it to make sure it's working correctly, and then most importantly, if it's not working correctly, change it, change your process. And you get that feedback of, hey, does my process actually lead to profits? And if it does, you keep doing it. So let's recap these 6 huge mistakes people make and how to avoid them. First, go for simple strategies. There is no holy grail. Second, try developing strategies with less than 5 variables, and if you're going to optimize, keep the optimization to a minimum. Try under 1,000 iterations, for example. If you're looking at metrics, make sure your metrics have risk and reward both incorporated in them. Don't just look at the reward side. That's what most people do. Avoid mistake number 4 by having goals for the strategies you create, and looking at a lot of equity curves so you know what's good and what isn't, and what's fake and what isn't. Then, for any strategy you create, make sure you have a quitting point. And then, to develop a strategy, find a process that works for you and that helps you to make money. Well, hey, if you've learned something new from this video, subscribe to my channel. If you want to learn to trade like me, visit my website at kjtradingsystems.com and tell me, which of these 6 huge mistakes people make have you made? Or which ones have you avoided? Leave a comment below. Let me know. I'm Kevin Davey, and thanks for watching.